I'm Freund with Dilbeck Estates and Christie's International Real Estate. Thanks so much for tuning into my podcast today. I hope you had a chance to listen to the first episode where we talked about cash, the importance of cash in the purchase process and buying your first home. So today we are going to talk about financing. So I mentioned before in the first installment here of the podcast that you needed to have a down payment. Now, the down payment can vary based on the type of financing you're seeking. Typically, traditionally, a down payment would be 20% of the purchase price. So if I'm buying a $500,000 home, I am going to put down $100,000. Obviously, that's a lot of cash to save, and there's a whole bunch of reasons why that's difficult. We all know them. It's not easy to save money in today's world. So a lot of people for the first home are actually going to put down less than 20%. Now, kudos to you if you're able to save 20%. You're far better off. It's less expensive financing. But nonetheless, there's no reason to wait if you can find a home that you like and you don't have the down payment of 20% because there are several different options available. So there are 10% down, finance 90%. There's 5% down, finance 95%. If you get an FHA loan that's offered through Federal Housing Administration, then you can actually come in with as little as 3.5% down. So on that $500,000 home, 3.5% is about $17,500. So you can get into a home for not a whole lot of money down. Now, we talked about in the previous discussion about the importance of things like closing costs and having reserves. So you do need more than just your $17,500 in that example, but those loans are out there. In fact, if you're a veteran, you can get a VA loan with as little as $0 down, which that doesn't suck. That's pretty awesome. And with all the veterans coming home from Afghanistan and Iraq, we really want to make sure that those programs are out there because, they've given contributions to us that are invaluable. So making $0 down payment loans available to them to purchase homes is a cool thing. But there are costs when you get into smaller down payments. And the most obvious cost, the thing that you hear about the most is PMI. This basically stands for private mortgage insurance. What this is since that 20% is kind of the go-to default sort of norm of a down payment, if you're putting less than that money down, the bank wants insurance for the balance of the down payment. In other words, I put down 5% and I didn't put down 20%. That 15% delta, you're going to buy insurance for, and that's called PMI. And it's kind of expensive. I'm not going to go into what it costs because it does vary from lender to lender, but it can be expensive. It is an additional fee of several $100 a month infinitum. Now, it is possible under certain programs that you could at some point build enough equity in your home. Maybe the market's appreciated. You've overpaid and you've paid down your mortgage where your equity position is now 80%. 20%, but your loan is now 80%. But that's not an easy thing. But usually it's property appreciation, and you can refinance and get rid of the PMI. With an FHA loan, you actually cannot get rid of the PMI. So you have to completely refinance with a different program entirely when you're doing that. So that's the type of those are different types of financing out there. Now you may often hear phrases like conforming, high balance conforming, jumbo, super jumbo. These are in reference to different loan thresholds. Now, not to go into too much detail about what kinds of financing are out there, who's backing them, who's behind it all, but suffice to say, Fannie Mae, Freddie Mac are your principal government-backed loans. What they are is entities that will purchase loan debt from banks and lenders as long as they meet certain criteria. And then they'll hold that debt or they'll sell that debt, but the government's guaranteeing that loan. So that's an important component because, if you get a guarantee of any kind, you're willing to take that risk. If there's a guarantee, then it's guaranteed. So that's in this case, guaranteed to buy it means I can make the loan and I know I can sell it to Fannie Mae or Freddie Mac. That's what that means. It's conforming. that means that the loan is below a threshold of 501 or whatever the figure is in the county that you're in, specifically 510, I think it is in Ventura County. So that's a conforming loan. A high balance conforming, I refer to as high BAL, that's lender speak. High BAL conforming is up to around 701 to 725, and it changes every year. That's why I don't remember what it is for this year with the virus and all. It kind of throws my memory awry. But anyway, the thing about the difference between high BAL and regular conforming is usually it's a little bit more expensive. So if I'm going over the $500,000 range and I'm in a high balance conforming loan, the government's still going to buy that loan, but they're they want a little extra money for it because it's more money than they really want to lend. Then you have things called jumbo. Jumbo, which is not common in many parts of the country, is exceptionally common in California, New York, Connecticut, Washington. These high real estate value states, we use jumbo financing a lot. So jumbo financing is over that 701, 725 mark, depending on, again, it's based on the county that you're in. So depending on where you're at, that jumbo market is going to be more expensive because you don't have the guarantee the federal government's going to buy it, because in fact they will not buy it. So now you're finding other sources that you have to sell. If you're a bank, you have to sell these loans to, because they don't just keep them. I mean, maybe your neighborhood community bank's keeping your loan paper on their shelf and collecting 3.25% or 3.5% or 4 or 5 or whatever the interest rate is. They're collecting that interest, and they're happy to get that rate of return, and they make these notes to their community, and that's just one of the things they do with the money that depositors give them. But more often than not, what they're doing is they're packaging that loan and they're selling it to the government or to some other entity. Well, jumbo, they've got to find this other entity. So that entity could be CalPERS, pension funds, insurance companies, endowments. These different types of operations are looking for strong investment, relatively conservative investment vehicles, and jumbo financing mortgages is one of those vehicles. So it's a secondary market. Now, for quite a long time in the 2000s, particularly after the Great Recession, the jumbo market, which should be more expensive than the conforming market, was actually less expensive. The rates were lower. Talk about an upside-down world. Why would it be lower? Because the demand is so high for that secure, steady income, real estate-backed loan that they could sell it for a lower return on investment, a lower interest rate. So you can talk about the way interest rates work, but basically, if there's a high demand on something, the price goes up. And if the price goes up, but it's a fixed rate of, say, let's say just for argument's sake, it's 3.5%. If it's 3.5% and you're, neutral, 0, 100, you're at 100 technically, and now somebody pays 110 for that 3.5% note, well, their yield isn't 3.5% anymore because now they just paid 110 for it. So it's actually maybe like 3.2 or 3.3 or whatever the math is. So that's what was happening. The demand for the jumbo loans was so high, the market was paying, willing to take and buy those loans for even a lower interest rate than what the face value was. So jumbo loans have been a really hot commodity now. As happened in 2008, is happening in 2020. In the coronavirus world, we have all of a sudden nobody wants to buy jumbo financing, or not nobody, but a lot of normal avenues to sell those notes. They're not in business anymore, and as a result, that means the demand is down. And what happens if they're only willing to pay $85 for that $100 note? Well, that 3.5% divided into 85 actually now becomes maybe 4%. So they want a higher rate of return to take on that debt. And so that's, secondary market. We can spend a lot of time on that, but just know that it basically goes conforming, high balance conforming, and jumbo. So you've got those are traditional loans, and with the PMI, you can get into the lower down payments. And if you're really at 3.5%, you can get an FHA loan. You just have higher PMI costs, and you have to refinance it out. And of course, if you're a VA, you can get 0% down, and you can get in with very, very little money. So these are the different types of financing that are out there. And one thing I do want to just touch on when we're talking about financing is different sources of the financing. So obviously you have the big banks, right? B of A, Chase, Citi, Wells. You have your Union banks and, Royal Bank of Canada and, different banks. And they are called banks because they take deposits and are insured accordingly by the federal government, and they make loans with that money. But there are other sources of funding that are not banks. One of the places oftentimes you'll find are insurance companies and different pension funds. They'll have loans available. Prudential used to be one. SunTrust is an investment, Wall Street money investment house that's making mortgage loans. But they're not a bank. They don't collect deposits. So that's sort of the definition. So what happens is who's selling their products? Well, they don't have their own sales staff, right? So, think Farmers Insurance versus Geico. If you want to go to Farmers, you go to a Farmers agent. But if you go to Geico, you can't get Farmers. They don't offer it. They offer, Geico, or maybe it's through a broker that you get it from. So the same is true with loans. A loan broker maybe has a wholesale relationship with SunTrust or with one of these other investment sources, and they're making the loans. That's a broker that's doing that. And then another way is direct lending through a correspondent lender. So these are lenders that have their own resources, typically Wall Street money, Wall Street backed money, and they have lines of credit, and they have stocks that they sell and stuff. And so they're the value as a company, and they borrow money and then lend it and then sell the note to somebody else, and they just keep making their little points on each transaction. So those are three different ways. Actually, I prefer correspondent lenders, to be honest with you. They're my favorite because they tend to be a little bit more lean and mean. They tend to be faster. Banks are, banks, right? They're slow. So with regards to, the different sources of financing, there's several different out there. So, choosing really depends on where you bank, who you're comfortable with. Find somebody you trust, have a relationship with them, and you're going to be giving them all your financials. Obviously, there's Rocket Mortgage. There's some online brokers. I'm not a huge fan of that. I know it's digital, and for millennials, it's really easy to just upload stuff with your phone and send stuff off. To me, as a real estate broker, it's really important that I'm dealing with a local lender because that local lender wants my business, right? They want the other realtor's business. So they're going to be out there looking to perform. They want your referrals in the future. Rocket Mortgage, they don't care about your referrals. That guy that you're dealing with is dealing with people online all the time. He or she is, they just don't care, right? They're just like churning it out. They may have great digital interface, but when push comes to shove, if you need something done, who are you going to go, pound on the door and go, hey, what are you doing? I need this. You're there in Detroit. What are you going to do? So I like the correspondent lenders. They do direct fund their own money. They tend to have their own underwriting staff. Underwriters are the people that basically put together your supporting documentation per the guidelines of whomever they're going to be selling the loan to, because they usually know in advance who they're going to be selling it to. If it's a Bank of America wholesale account, they're going to be underwriting to Bank of America's guidelines. If it's going to be one of the companies that handles Fannie Mae, then, they're going to follow Fannie Mae guidelines. Anyway, so those are different sources for financing. We can get into that later too, but just know the main point is there are different types out there, and you want somebody local. If you can find somebody local, your realtor will probably be able to help you with that. Anyway, that's all I got for now. That's on financing. I'm Tim Freund. This is your first-time buyers home purchasing guide podcast. You can find me on the web at thousandoaksrealestate.com. You can follow my blog, therealestateconversation.com. If you like this, please subscribe. Give me a like. Tell your friends. Obviously, I make my money selling real estate in and around the Ventura, LA County line. So if you know somebody looking, send them my way. Thanks so much. Look forward to talking to you next. Talk to you then.